Japan owes more than 200% of everything it produces in a year. It's the largest debt in the world, held by a single country, and it never stopped growing. More than 3 decades after the bubble that created this problem burst, no Japanese government has actually managed to fix it. Every generation just found a new way to push the bill further down the road. There are 1,026 yuan trillion in Japanese government bonds circulating through the financial system, and a huge slice of that sits in the hands of a single institution. It's the only reason this whole system is still standing, and for the first time in decades, it has started to pull back. So why does Japan's debt never stop growing? And what happens when the institution holding all of this together also starts letting go? I'll come back to that exact number shortly, but to understand why this problem was never actually solved, we need to go back to a bubble almost 4 decades ago.
Business now with Charles. He's starting with some disappointing, though, growth data. This is out of Japan, isn't it?
The United States has joined Japan in a rare coordinated intervention in foreign exchange markets. The move aims to stabilise the yen.
Japan built a growth machine so efficient that nobody noticed when it started producing a bubble. From the post-war years through the 1980s, the country rebuilt its industry around automation and efficiency, exported to the world under a managed exchange rate, and relied on a young, growing workforce to sustain production and domestic consumption. That machine worked so well, for so long, that nobody wanted to believe it when it started spinning too fast. In the second half of the 1980s, Japanese stock prices tripled and land prices in major cities nearly quadrupled, fueled by banks lending aggressively against those same assets as collateral, a cycle that fed on itself. People bought into the idea that it had no limit. Then came the turn. In February 1990, the market began to collapse. Within a few months, the Nikkei index had lost 40% of its value. 2 years later, the drop had passed 60%. Land prices took longer to fall, but they fell the same way, more slowly and more painfully, over the following decade. The bubble had burst, and the Japanese government had to decide what to do with an economy that had overnight stopped growing. Tokyo's response throughout the 1990s was to spend. Stimulus packages, tax cuts, and infrastructure projects tried to reignite an economy that had stopped growing. But there was another problem. Banks were weighed down by bad loans made during the euphoria of the bubble, and bailing them out required even more public money. None of these packages, on its own, managed to pull Japan out of the hole, and the decade became known as the lost decade. But spending has a price. A good portion of these stimulus measures was financed with new debt. And so, year after year, the ratio between what Japan owed and what Japan produced kept rising from a manageable level in the early 1990s to a number that, by the end of that decade, was already worrying economists around the world. The government had managed to buy time, but to keep that game running, someone needed to keep buying the debt financing all of it. And that's when the Bank of Japan stepped in. That's when the Bank of Japan decided to do something no major central bank had ever done before. In February 1999, it became the first central bank in the world to take its interest rate to essentially zero, a move described at the time as unprecedented, both in and outside Japan. In the early 2000s, it went further. It launched a massive asset purchase program, injecting money directly into the economy. In 2016, the central bank did something almost unbelievable. It pushed rates into negative territory and started directly controlling long-term interest rates. In practice, the government took the wheel of the market and dictated exactly how much its own debt would yield. The practical result of all this, the Bank of Japan became the biggest buyer of the government's own debt, at one point holding nearly half of all Japanese government bonds in circulation. Domestic banks and insurers hold most of the rest. Foreign investors, by comparison, hold about 13% of the total, a small slice but a growing one. So why does this matter so much? Because it means Japan, in practice, owes money mostly to itself. Except that this central piece of the system is now pulling back. The Bank of Japan has been shrinking its own bond portfolio. Its holdings fell from 91% of GDP in June 2024 to about 80% of GDP in January 2026, with projections pointing to a further drop to close to 69% of GDP by March 2027. When the biggest buyer starts selling, someone needs to fill that space. And that's exactly where this story gets interesting. Japan's debt today sits above 200% of GDP, more than any other major economy on the planet, comfortably ahead of the United States, 126%, or China, 107%. But the number, on its own, is misleading. In recent years, that ratio actually looked like it was improving, falling from nearly 228% of GDP in 2022 to around 203% in the IMF's projection for 2026. The reason is simple. As long as the economy's nominal growth outpaces the interest Japan pays on its debt, the ratio falls on its own, without any extra effort from the government. Except that decline is a truce with an expiration date. The IMF has already put a date on it. Starting in 2035, spending on interest and on health and long-term care for a rapidly aging population will outpace that growth, and the debt will start rising again. Interest payments alone are projected to double by 2031 and exceed 4% of GDP by 2036, as old bonds issued at low rates get rolled over into new bonds at higher rates. And behind those spending numbers is a force that isn't going away. Japan has the oldest population in the world, and it has been shrinking since 2008. Fewer people working means fewer people paying taxes. More elderly people means more spending on healthcare and pensions. It's the same gear that has been turning for decades, just with fewer people left to push it. In other words, Japan never solved the problem that started in the 1980s. It just found a way to manage it for decades, and that arrangement has an expiration date. Here's the part most people get wrong when they think about public debt. Size isn't what decides whether a country collapses. Ownership is. Practically all of Japan's debt is issued in yen, the country's own currency, and more than 80% of it sits in the hands of institutions inside Japan. The Bank of Japan, commercial banks, insurers, pension funds. The average maturity of these bonds is around 9 years, which gives the government a generous cushion of time before it needs to refinance any portion of it at higher rates. Compare that to a country that owes money in dollars to foreign creditors with short-term maturities. If investors lose confidence, that country can find itself unable to pay overnight. Japan doesn't have that problem. It doesn't depend on the goodwill of strangers, it depends on the savings of its own citizens, channeled through banks and insurers that are, by law and by habit, major buyers of government bonds. If you've ever heard someone say that a debt of 200% of GDP should, by definition, break a country, now you know why that hasn't happened here. It isn't magic. It's financial engineering built over decades, resting on a savings culture that's a leftover of that exact period of accelerated post-war growth. The proof is in the comparison. Greece also once had debt above 200% of GDP. At the height of its crisis, today it sits well below that, after a partial default, an international bailout, and a recession. The difference between Greece and Japan was never the size of the debt. It was who financed it. Greece depended on foreign creditors, in a currency, the euro, that the country didn't control. When confidence broke, there was no domestic central bank to hold interest rates down. Japan never had that problem. That's why nobody fled. Back to that number from the beginning, the 1,026 yuan trillion in bonds. That was the anchor that held Japan up for 3 decades, and now it's pulling back. Japan's biggest debt buyer is leaving the market, and the signs are already showing up. In 2026, the yield on 10-year bonds hit its highest level since 1996, and the 40-year yield broke above 4% for the first time in history. The price of borrowing money is climbing again. Now the system itself needs to figure out who's going to take the place the Bank of Japan is leaving behind. For the first time in decades, the market is demanding a real premium to hold Japanese debt because the risk baked into it has stopped being hypothetical. Nobody ever actually fixed Japan. Not the bubble in the 1980s, not the stimulus packages, not 30 years of zero interest rates. None of it solved the problem. It only bought time. For 3 decades, the structure of this debt was stronger than its size, and nobody really knows how much longer that can hold. If you enjoyed this video, follow the channel to catch the next essays, and share your take in the comments. If Japan spent 3 decades buying time, what happens when the time finally runs out?